Good day, everyone. Well, we have a market that is at another tipping point in terms of determining its direction. It's had a lot of trouble trying to get any kind of bounce going. It gapped up today just because two central banks are talking about relaxing monetary policy again, yet again, in this broken record. And we'll see how far this bounce can last, but it seems that the weight of what the central banks have done over the last few years is finally coming to roost in terms of this corner that just gets tighter and tighter in terms of how central banks paint themselves into it. And we're just seeing a lot of volatility, a lot of riptide action as institutions are having a tough time, I think, making heads or tails out of market direction. You know, you can see it in the exaggerated volatility and exaggerated volumes that accompany that volatility. So, you know, it's almost like flip a coin in terms of where the market's going to head from here. That's as of right now. Of course, things can change by the close, but there are some occasional stocks that are just straight up from bottom patterns into resistance. Those are more vulnerable to backing and filling, at least, if not rolling over again. So those are some good short candidates that Gil's going to talk about later today. So there's always opportunity, but in terms of market direction right now, there's no real odds that either strategy senses at this juncture. Thus, both of the models are in cash. And we had a question about, well, one member can't attend, but he listens to the webinars after the broadcast, asked about model building and how the MDM came to be, and essentially any model, MDM notwithstanding, has to go through very rigorous type of testing. I can't recommend books on it because this is all self-taught. The MDM was inspired, as I've said, by O'Neill before I was even at the firm, because I really liked the idea that he could use the M in Cancelim to keep him on the right side of the markets. So with that inspiration in hand, I took to studying painstakingly price volume action of major indices going back. Started with going back one cycle, then two, then three, then four. Then before I knew it, I was going back decades worth of data and finding that certain markets have certain characteristics. And so creating a set of rules that fits all market environments is not realistic. In other words, there are no black boxes that can't change. Any black box, it's not a black box, because all black boxes imply that their strategy stays fixed. But markets change, and that's the one thing that's guaranteed, is that the only thing that doesn't change is change. So with that, I knew that any model that I build has to be, I don't like even the word model, but any model I build has to remain flexible. And I created some rules in terms of being able to, on a timeline basis, when the model senses a big change, a material change in the markets that persisted more than a few months, then it's going to adopt that material change into its algorithm, if you will, to its trading rules. And fortunately, in the 90s, the model didn't need to change, because the 90s were a rip-roaring bull market, and the characteristics pretty much stayed the same, and consequently was quite highly predictable. And then even after the dot-com bubble burst in March of 2000, while it's the beginning of the bubble bursting, the model still was able to maintain itself because, believe it or not, those years, 2000 to 2002, were quite highly predictable. There was no market manipulation, and you know, NASDAQ lost I think 70% of its value, but there was a lot of money that could and otherwise on the short side because and it was only really with the applicative easing in 2000, late 2008, after the financial implosion, that we had all of this manipulative nonsense that began in early 2009. The model picked it out, and that's how it was able to outperform 2009, or let's just say keep its head above water, because as you all know, the indices were off to the races then, but it was a very choppy uptrend, and nevertheless, the indices finished the year up quite a huge amount, and the model was able to keep its stride, and then 2010, 2011, the same thing. 2013 was the start of a real pronounced QE3, and that was also the beginning of the one time, hopefully the only time we'll ever see the S&P not correct more than several percent over a period of a couple of years, because there were no real corrections after QE3. And it took until, not just the end of QE3, but after QE3 ended, 2015 was, by a lot of media accounts, challenging year in 78 years of market history, just because the market didn't go anywhere. And it had a couple corrections in there. They were short and sharp-lived, and very difficult environment after trading. So we got, right now with the markets the way they are. Oh, I'd also like to add one thing with the rules. I put some of these answers into the Q&A in terms of model building. So if you not Google, but if you type into this keyword search bar the basics of model building, then you should find some answers. But I will say that in terms of model building, I can't recommend any books for Google for that sort of thing. There are obviously some good books on model building. You have to be very rigid about your approach, very, very strict in terms of back testing, in terms of not letting your own biases get in the way of what you're doing. So just go ahead and Google that. If you have follow-up questions, go ahead and email me, and I can point you in the right direction. Or at least I'll add to the FAQs if it's a good question, and I think it'll help members in general. And ultimately, as far as the markets, well, oil's bouncing on the basis of this, more QE from potentially out of Japan and potentially out of the EU, the ECB, with Merkel making that announcement. And I think they meet in March, so basically, they've got a couple. What is it? January 22nd. So I think the market is all psychologically driven in terms of QE and in terms of what it's going to be doing in the never-ending battle between these central banks who want to prop up the markets artificially, and I think the internals, which have deteriorated considerably, and that's going to be a big battle. At least the Fed right now is still standing pat on interest rate hikes, although now the futures are saying instead of 4, it's going to probably just be 1 hike this year, but at least they're still on that side of the fence. So I think that we're going to see lower oil, lower commodities, lower economic growth. China being the bellwether, dropped under 7% for the first time in how many years was this? 12 years or something like that. So not all is well, and we're actually probably going to continue this roller coaster ride, as we said earlier this year, that 2016 could very well be a year of great volatility, and so far it's playing out that way. And with that, I'll turn it over to you.
Okay, maybe you guys were noticing as Dr. K was talking, I was flipping through charts of stocks that I'm seeing pushing into what I think may be shortable zones here. It's going to depend on how far this rally carries. It looks like it's giving way right now, but yesterday we saw it come in 100 points very rapidly a couple of times and then turn around and go back up, which is typical when you get into this zone, which I'm referring to as the Tigger market zone, where things get all bouncy, flouncy, and trouncy, and whatever else is in that song from the old Winnie the Pooh movie, if any of you remember that. The wonderful thing about Tiggers. Anyways, I think this is all fairly concrete. I mean, you had a number of breakdowns in big stock names, and I've been going over this repeatedly since the new year started, where you saw a number of breakdowns in names like Facebook and Google and Amazon and Microsoft, and Priceline had already been coming down, but all the stocks that were holding up, Netflix is another one, all started to come apart. So in my view, that was a point to start getting short, which was in here. And so we've broken down, and I think it gets fairly concrete as you undercut not only the August and September lows, which are in here and here, but you also undercut the well, let's see, what am I doing here? I want to get rid of this. You also undercut, hey, I like that. What happened here? I'll have to erase those later. You also undercut the October, where are we? October 2014 low. I don't know if you guys can see this, but I'll shrink it down a little bit here. Yeah, market's giving way here pretty quickly. So, let's see. Very hard. Let me change this to a weekly and you'll get a better idea of what I'm looking at here. Don't pay attention to any of the volume. So, but you can see here, yeah, here we go. On the weekly chart, you can see that we've undercut this 48.21 low, actually, to be precise. You got close to the 40-week line here, and so you're rallying. But I mean, it all made sense to me because if you look at what's happening with all of these short sale targets that I've been working over the last couple of weeks, they're all coming into areas where you would expect some sort of a bounce. For instance, you had LinkedIn here undercutting. It actually undercut this low here on, what is that, Tuesday. And so that you notice the market rallied very sharply off the lows on Tuesday, but I was watching it come down. We're down like 565 Dow points. I think that was the low point. I'm seeing all of these names now really getting deep into their patterns, and they're all undercutting. So to me, if you've been campaigning any of these on the short side as I've been, you're starting to get a sense that we're ready for a sharp reaction rally of some sort, and that's precisely what we got. So you see LinkedIn there, you see Tesla undercuts. Let me. To see this, you got to go. You not only undercut all of these lows from October and November, but you also undercut the August 24th low. But the rallies here are very feeble because you're seeing most of these things, for example, in LinkedIn, pushing back up into the 10-day, and they're reversing today. And let's see, some others that have reached logical points like Facebook. Here's one that violated the 50-day here early in January and busted towards the 200-day, undercut it on Tuesday, and then pushed up out of there, but it undercut this low and it's getting into this area of congestion. So a bounce here looks logical, but all you do is rally into the 10-day today, and you're not really getting up too far, and it's very difficult to see any long setups per se here that I really want to play. Netflix is a little bit tricky because it was, I think it traded at 124, somewhere around there after hours on Tuesday after they announced earnings. And by the end of the after hours trading session, it was somewhere around 115, I believe, which put it just below the 10-week line and the 50-day line. So, you could have tried to short it after hours, but then it gaps down. Well, actually opened basically where it closed the day before and then blew to the downside, looked shortable, and then yesterday you get this reaction rally into the 10-day. Now we're busting the 200-day. So that one looks like it's probably done. And maybe it becomes a longer-term short. But recall how I've been talking about this, and on the weekly chart, you see it has had a long move. And now you come out of this sloppy base, and the breakout fails. This is where IBD is telling everyone you got to buy it because it's a breakout, quality stock. And of course, we know those don't work anymore, and the thing just busts. So it looks like it's headed for the downside. I suppose at this point, if it rallied back to the 200-day, it might give you a better short sale point, but a bust to the 100 level might also be looked at that in the same manner. I know that Apple has remained below the 100 level, tried to get above it this morning, and so you could have seen that as a short-term short sale point. But I think going into earnings next week, you kind of want to play it cool and maybe not chase any of these. if you're going to take a short position, you're trading it for a couple days at least until earnings come out. I don't know if I'd want to sit through earnings in any of these because you never know what's going to happen. Let me just go through some of these. I'm going to show you some more of these. You look at Expedia is another one we've been talking about on the short side. They actually undercut all of these lows over here on the left side. You see that? Now you're at the 10-day and you're starting to falter. So these may all become actionable. And for those of you who use a 620 chart, that's one way to time shorts as you're coming into an area of logical overhead. Sometimes it'll work just into in midair. This morning, the ones I'm really interested in here are the cruise lines because they're all starting to break down. Look at this choppy, ugly pattern on the weekly chart, and you can see this is just a really ugly, choppy pattern. Now it's starting to break down, and has it undercut all these lows on Tuesday, and of course now you get this sharp rally. I mean, it's one of the reasons I'll tend to look to cover on undercuts of prior support because the rallies can be very sharp, but all they do is set up new short sale points. So this one is coming up into the underside of this little base or congestion area, so that makes it shortable there. Using a reasonably tight stop. You have Royal Cruise Lines is another one that reversed today, getting into these lows and reversing there and at the 200-day moving average. So, that looks like it probably would retest these lows. However, I think all of these are announcing earnings at the end of next week. So if you're playing these, and I'm short CCL right now, you're looking for some sort of break back to the lows before they announce earnings, which I think it's possible depending on what the market does. We're up 124 on the Dow. What was the peak, Dr. Hay? Weren't we up like 250 or something? I don't know. I saw it earlier before I started nailing things on the short side. Earlier it was taking off to the upside.
Yeah.
Yeah, so...
We were up,
go ahead.
We were up about 120 points more than we are now. It's about 250.
Yeah, and the other thing is if you're trying to play the long side, it's a little bit difficult. I took some positions on Tuesday. First Solar, has had some pocket pivot type action in here along the 50-day, and that's good for rally up into this area, which I think is a nice profit-taking zone. Cyber also off the 20-day here after this pocket pivot here, followed by a gap up move on big volume. There's rumors, or there are reports that they're in talks with Checkpoint Software to be bought out. Whether that's going to happen or not is another issue. But I thought if you got up into this 50 area roughly, into this area of congestion, that's good for a quick trade at like 5%. This morning I think it was trading 49.73 at the peak. So, I mean, there's some trades you can pick off, but the bottom line is you actually have to be long overnight to catch the gap. Because once they gap it up, generally what you see is things gap up and then they sit there. And that makes it problematic if you're trying to come in and think you're going to buy something and start making big money by the end of the day. I mean, I guess if this market turns around and hits up again 250 points on the down, then yeah, I guess you can make some money. But from my perspective, I'm watching a lot of these names on the short side. So Google into the 20-day, you can see there. After more or less filling this gap and rallying up, but now it's getting into the 50-day and an area of congestion, so it might roll over here, so you got to watch that on a 620. Let's take a look at this just real quickly. Yeah, not really getting a sell signal yet. You can see that. It's kind of starting to look that way, but we'll see. I mean, this market could be all over the place. Yesterday I was watching it go up 180, then up 40, and then back up 160, and then up 58, and then up 140 or whatever, and then by the close it kind of fizzled out again. And so it's just very choppy on an intraday basis. Makes it very difficult to play, but I think that's the way it's been for the most part. But I think you're in a bear market. Dr. Hay, you think we're in a bear market? Do you think this is going to get a lot worse? I mean, the Russell 2000 has already gone down, I think, a peak maximum of minus 25% off its high, and you saw the New York Stock Exchange Composite get down about 20, just a hair over 20% on Tuesday. So now they're all in bear market territory. Do you think we're heading, that indicates that we're in a longer term bear market?
Well, the world's been in a bear market actually since 2014, and all these markets are interconnected. So I think, it's only been a matter of time before the rest of the world starts to drag down the U.S. markets, and that's what we're seeing now.
Yeah.
Especially with the Fed having ended QE, there's nothing more to prop up artificially these markets, and so that's fantastic news, because then in terms of volatility and profit opportunity, we're in a better environment this year than we have been since I'd say 2011. 2011 was a great year because of the volatility, which appeared chaotic, but was actually had some predictive value, a lot of predictive value to 2011's volatility. But 2013 and 14 were like the market's in a straitjacket, and it just can't find a good correction. And at the same time, the rallies were pretty feeble. So 2013 to 14, if you look at that pattern on the S&P, you'll be hard pressed to see a pattern like that ever in the history of the S&P. It doesn't exist because the Fed's never stepped in like it has in this sort of market manipulation. And then, of course, 2015 with QE over, that was a challenge all to itself because of the trendlessness of it. So I think we've busted out through this straitjacket the market's been in, I do pray that the Fed's not going to step in with some sort of QE4.
They are.
Their program, but yeah, I know that's the problem, is that if the markets really start to unravel, then they're going to accordingly, have no, from their Fed speak, they're going to say they have no choice, and they've got to step in, and I guess we're going to just see more, then all these central banks in unison will be playing this QE symphony, and that'll be a sad day if that does happen.
Hey, it's
when it happens.
It's America on the 39th day, as Ed Sakota would put it.
Yeah. That's where we're at, and that means there's a lot of roller coaster turbulence coming. There's a lot of tsunamis coming our way, which is good, because I don't think we're going to see 2012, 2013, 2014 repeat. Things generally often don't repeat in that controlled fashion. So, yeah, it should be fascinating what unravels from here.
Anyways, let's go through some more of these names that are on my short list of short sale targets that are rallying. So I'm going to go through, let's see, let's start with, we looked at Apple, which I think, shortable possibly at the 100 level here. Let's make them nice and big so you guys can all see them. Here we go. Is that nice? Is that big enough for you guys? How many people out there need reading glasses these days? Okay, so Amazon is another one. Whoops. And that filled the gap here. So that set up, see how this set up a logical rally on Tuesday? And when you're seeing that, okay, I'm looking at it, it could go to the 200-day, but it really depends on what the market does. So at that point, if you're shorting it, on the basis of it now failing on this BGU here, then I think that, you're covering on the turn and then seeing where things go from here. Now you're rallying up to the 10-day earnings come out next week. And you might get higher. I'd be looking for some kind of rally on earnings. On most of these, that's what I'm looking at optimally. If they've already announced earnings, then, it could be, makes it a lot easier, like with Netflix, for example. So you got Amazon, let's see. Spidey's another one we've been talking about. That became shortable. Notice how it filled this gap here, over here. You have this gap, and it filled that, and it's now rallying up into the 20-day and these highs, so that's potentially an area where it could be shorted. They come out with earnings in February, I believe, so that's one to keep an eye on. Facebook, as I showed earlier, bouncing off the 200-day here, and really looking like death, on Tuesday. And they come out with earnings next week too, so I'd be watching that for a rally. But you can see how they're all bouncing, but everything looks like it's bouncing into overhead. Here's a gap down move, which might be a shortable gap down in Intel, using the high of this day here at 30.50 as a stop. You got very close to today at 30.24, putting it within shortable range, using that as your stop. So that was one potential stock to trade, and you can see that you got a 620 sell signal early in the day at around, a little after 7 o'clock my time, which would be a little after 10 o'clock for those on the East Coast, and you can take it from there for those of you who are in other time zones. And let's see, then you have Microsoft, which I'm actually short now into this rally. It's coming up into this area, but it's starting to show a little bit of faltering. You have to cross here at the peak, which looked like a shortable event, especially since you're 1, 2, 3 days up, and you're coming into this area of overhead. They come out with earnings next week, so basically this is a day trade for me. I'm hoping it rolls over. It's hanging in there around 52, not too far from where I'm shorted, so kind of undecided at this point in terms of what it's doing. But it's slow, so it's not like it's going to get out of control on me real quick. Netflix breaking the 200-day, like I said. You could use the 200-day line at 103.42 as your stop and just be short it. And getting below the 100 level sort of seals the deal, which you could then use that as a trailing stop if you want to keep it tighter. So price line is way down. And we've talked about this one when it was up here. If you look at the pattern on the weekly chart, let's do this. You've undercut all these lows. Maybe you undercut this low, which is from January of 2015 eventually, but in this position it looks like it needs to rally, but it's right at the 10-day and going nowhere fast, which is typical of a lot of these names. So, you know, I don't know how far this rally can carry. My thinking is not very far, but I could be wrong. But what drives most of that thinking is basically on what I've observed the market to do recently, which is when you see it turn off of these lows, you'll generally see stocks hitting some buy points or showing some constructive action. You don't see any of that now. The things that look the best are defensive stocks, and even those don't look so hot. I think Philip Morris, MO, is that Altria Group, you know, that's holding like in a base, but even that doesn't look so hot. What's another, is RJR still out there? No. Let's see, there's MO, what are the, PM, Philip Morris, right? Yeah, there we go. See, that's kind of hanging in there, but it doesn't look so hot. So even the defensive names aren't looking so hot here. So, let's see, continuing, I'll get to some questions in a second. You have Tesla, I already showed, undercut some major lows. Expedia, on the weekly chart, let's make this bigger. Undercut these lows here, so now it's rallying up, but it's only getting up to the 10-day line, so it looks like it's going to reverse here. Salesforce is stalling out as well. It's not quite up to the 10-day line, but that's another one. Undercut this low way over here. I don't know if you can see it, this low way over on the left side. You see that on Tuesday, and that sparked the rally. Somebody's saying you see a lot of double bottoms forming with this recent quick homogeneous sell-off. Yeah, but those don't mean anything. I mean, you want to slap a double bottom. How do you know it's a bottom? How do you know? In my view, these are just retesting or undercutting prior lows, and they're bouncing. That's normal. But to think that they're buy points, you know, unless you're trying to sell people on some idea that they need to buy stocks here, I think that's kind of silly. Thinking that that's a buy point. I know some people are these shakeout plus threes or shakeout. I wouldn't look at them that way. You're in downtrends, and I don't see any of these things as really being all that viable. And I think if you step in and try to buy something, you just may end up stepping in some doo-doo. So I don't think this market's something I really want to buy into, to tell you the truth. I'd like to see more setups. There were a couple of things I would trade, like I bought on Tuesday, and you know, I'm gone from those. I've had my moves, and those you get 4 or 5%, you take them. But other than that, I don't really see that these are double bottoms that are meaningful. I think it's just slapping a label on something, trying to make a bullish case that doesn't exist for the most part. Let's look at Love. This is hanging along the 200-day. This looks shortable using the 200-day line as your stop. They came out with earnings, I guess, on Tuesday, or was it Wednesday? One of those days, I forget. But it bounced and became shortable yesterday up underneath this area of overhead congestion. And you look at JetBlue, and these are all the names on my short sale list. This one's rallying right in the 20-day. That might be shortable there. Palo Alto Networks. It undercut a major low, actually. Yeah, see this? See how it undercut this low here on Tuesday? And so that triggers a rally, and so far it doesn't seem to be getting above this low at 150 or so. And it's just all just, you know, it's really not getting anywhere. So to me, these all look like dangerous patterns, and I don't really see why anybody would be dumb enough to try and buy these unless you're buying them for a short-term trade. So I know all the pundits and the TV talking heads and all the guys, the brokers and financial advisors all talking their book on TV, tell you that, oh, this is a buying opportunity. But if you're always holding stocks and you never sell anything, where do you get the money for the great buying opportunity? I mean, the only people who have money to take advantage of any buying opportunities would be anyone who sold stocks earlier in the year when the signals were all there, in my view. So, I mean, it wasn't really rocket science at that point. Once you saw the breakdown in the big stock NASDAQ leaders, which was the only place you were seeing leadership as the market breadth just got narrower and narrower, once those started to break down, in my book, that's telling you you're heading lower. So that was pretty academic to me at the beginning of the year. Maybe not so much to other people, but it was to me. And now at this point, I'm just looking for the next shortable bounce because I think you're probably in a bear market, but you never know for sure. I remember Bill O'Neill, and I've talked about this story many times, in June of 2000. I believe it was June 2nd. We were on the floor of the New York Stock Exchange, Dr. K and I. You had a big jobs number or something, and the market just roared out of there. And O'Neill was saying that, it was 1962, and we were bottoming. And he had no idea at that time that we were going to be in a 2-3 year bear market. Nobody knows at the outset. So all you can do is play what you're seeing in real time, and what I'm seeing in real time doesn't look so great. So I'm just kind of sitting here trying to pick off things on the short side and see how that goes. And I may have to run away and come back later, but that's mostly where I'm leaning now, having sold any of my shorts, my long trades, my short-term long trades over the last couple of days. And I think today's gap up gives you the perfect opportunity to do that. But you have to be a little bit tricky, and it is tricky. It's not, like I say, they're long shots, and I mean that in every sense of the phrase, I suppose. Here's Walt Disney. Look, that's very pod-like, isn't it? Looks kind of, well, I can make it look less pod-like. Whoops, let's see. But it got close to this low here. Never really quite undercut it. So probably a short in here. You got some overhead right in there, and that's looking maybe like it's going to roll over, but it could push higher. But that's another big stock that was leading and then broke down. Here's Celgene coming up into this area of congestion at the 20-day. Expected to come out with earnings next week, as is Amgen, which is rallying up into the, looks like that confluence of the 50 and the 200-day moving averages. And it found resistance at the high of Tuesday this morning. So maybe that will roll over, I don't know. But these are in shortable positions. Again, with earnings coming out next week, not so sure you want to sit through earnings, but they are coming into shortable positions. Here's Amgen doing the same thing. So and I think all of these, well, Celgene and Amgen next week. I'm sorry, this is Celgene. I'm getting these screwed up. Here's Celgene into the 20-day, right. And Celgene and Amgen, I believe, announce earnings along with Biogen next week. And then I think on February 2nd, you're going to get Gilead. So LinkedIn, undercut, like I said, undercut this low here. And it's still this low here, but it's running into resistance at the 10-day line. So if this market reverses today, you'll go back and say, oh, the 10-day line was resistance. And it is your first point of resistance if something is in a sharp downtrend, because usually, a body in motion will stay in motion. And my studies of the short side show that the 10-day can work out as a short sale point on a rally, but often the 20-day is a more a solid area of overhead resistance. And as you move higher in the pattern, it all starts to depend on what the general market is doing. And so you have to sort of watch the two in synchrony and see how they're both acting. So from here, I think the market's vulnerable to rolling over again. So I think you can test some of these. Just keep very tight stops. Let's see. Workday is another one that I've liked on the short side when it was up here. And I think we talked about that. But again, here you have, we look at this thing undercut this low way back here in April of 2014. Undercut the August and September lows. And now it just sharply rallies back to the upside. It runs into this little bear flag, and it's finding support above the 10-day line. You see how the 10-day line isn't really all that reliable as an area of overhead resistance, but it can serve as a guide in very weak markets. So the assumption then, if you're going to short into a rally like this, is that it won't go too far past the 10-day line, and that the market will remain very weak, and is very weak. And I would think that the action, even yesterday, the Nasdaq was up pretty good. I think up 35 points at its peak, and then it ended up like up 0.37 or something like that, not even a full point. And you saw during the day it would be up 18 and then 0, and then back up and back to 0, and just flying back and forth. Now we're starting to see this come in when Dow's up 115. And so you might see some of these roll over, because I think the market is actually weak. That's my primary point here. I'm trying to keep an eye on things. I've got putting out some positions short as they've run into overhead resistance here, so I'm trying to trade and talk at the same time. As long as I don't chew gum too, I'm probably okay. Starbucks got hit after earnings, and that looks like a short to me. You know, I'm kicking myself because I shorted the stock towards the end of the day yesterday, thinking I'm going to hold a small position, you know, 2,500, 5,000 shares short overnight into earnings. I was just feeling bold. I don't know why, because I think the Wall Street Journal had an article about how they were going to announce great earnings. Everybody's talking about how they're going to announce great earnings. I thought I'd fade it, but I have to admit to chickening out just before the bell and covering my position. Of course, when you do that, it's going to break, and it did. Opened up today. Actually, after hours, it was down close to the 200-day line, like 56.40 something I saw it trading at. Now you're rallying back up to 58.33, but it could roll over. If you look at this, it's had a big run. It tried to break out of this V-shaped structure, and so you would consider this to be a breakout failure. And how do we know, or we know that these work, so in this particular way once they've broken down. So how do we know when you might be running out of gas? You watch the several rallies into the 50-day or the 20-day moving average. You notice how in this case the green 20-day line serves as an area of resistance for the stock. So if you were shorting it, that could be a very tight stop. If you wanted to give it more room, about 3% to the upside, that would take you to the 50-day. So that would be how you handle that. And this is setting up as a late-stage failed base. And we know, for anybody who's read the book Short Selling with the O'Neill Disciples, you know the way these will work. The 20-day and the 50-day become your most important moving averages. As the stock starts to break down, the 20-day can become more relevant, but you're watching for rallies into either moving average as potentially shortable. But we can see that following this breakout here, this turkey's failed. And we'll see how it ends up today, but you know, I'd be watching for rallies as potentially shortable. But again, you're seeing this is another big stock NASDAQ name that has essentially broken down. And this was all starting in earnest at the beginning of the year. In fact, this started earlier. And some of them did start breaking down before then. So it wouldn't surprise me, you know, the Dow's up 115 right now, so it's given up over half of its gains. To tell you the truth, it would not surprise me one bit to see this thing turn around and go back up 200 again in 5 minutes. So that's kind of where you're at. You're in the Tigger zone. Let's keep going through these. Panera. If you guys remember, I talked about this one as being potentially shortable on the basis of this late-stage failed base concept. Again, here's a double bottom, okay? And you had a breakout attempt here that never quite broke out, and it failed. So as I was telling you guys last week, watch this thing around here for a failure along the 20-day moving average. Boom, you got it, and now it's busted below the 200-day, the 50-day. I think they came out with earnings in, we're up 104 now. We're starting to falter a little more. So now it's busted both the 50-day and the 200-day, and rallies up in either would be your short sale points. Let me check real quick where when earnings come out. 2/9, so second week of February. So plenty of time on that one. Let's keep going. AYI, Acuity Brands, is setting up. This thing's had a long run. So now what you're looking at here is you got a left shoulder. See that? That forms between late October and early or middle of November. And then you get a rally. Now this massive volume break. See, this is a massive one. I can make it more massive. See that? Look at that. That's a massive volume break down the right side to the 200-day line. Sets up the right side of a potential head and shoulders in progress. So I'd be looking for any bounce off the 200-day to short into. But notice how this thing just doesn't seem to be able to get up beyond, say, this high here on this rally attempt, and it just continues making lower highs and now lower lows, and so maybe this thing rolls over and it becomes a thematic short based on the fact that it's had a big run and it's starting to form a head and shoulders. However, you could also look at it as a late stage failed base. Here's the breakout here on the base, and you failed, and so any rallies into the 50-day or the 20-day from here would be your best short sale point. So you know, all head and shoulders formations start out as late stage failed bases. That's pretty much a fact, and you can see that in this case that's true because you have a breakout here. It fails. The failure on the base breakout generally will form the right side of the head in what later becomes a head and shoulders formation. So when I was studying all this, and this goes way back to the early 2000s, and when I was writing that first book for Bill O'Neill, How to Make Money Selling Stocks Short, that came out in late 2004, I was noticing that the right side of all these head and shoulders formations were late stage failed bases. And so I began to work out the precise mechanics for shorting it earlier in the pattern rather than waiting for a full-blown head and shoulders to form, because by the time that happens, a lot of the move has been lost. And then, of course, more recently that's broken down into fractals and the whole 9 yards, and you can read all about it in the book. Let's see. Avago. Dr. K, that phone is obnoxious. You need a new ringer for that thing. So I have one that quacks now, so it sounds a lot cuter. It's the ugly duckling.
Yeah, we're going off all the broadcast, of course. This is the first time since we've been here it's doing this, so I'm just shutting the thing off.
Yeah, that's a good idea. Unplug it. You don't need a phone. I mean, that's so like 90s or 80s. Anyways, here we go. Avago rallying up into overhead. You see how it gets into this area and finds support on big volume, but it's starting to roll over. I would like this at the 200-day line at 129.09 optimally as a short, but it doesn't seem to want to quite get there just yet, but maybe that happens later. I think these are all Avago, SWKS, Skyworks, NXP Semiconductor. These are all announcing over the next week, I believe. Let's take a look real quick. I like HGS Investor software because they have the accurate date, which is available. I've never quite understood why O'Neill, those guys can't get the right date on their charts. They frequently have the wrong date. So anybody who uses MarketSmith, I think they're showing 128 for Priceline when it's well known, and you can see it on the NASDAQ.com website that it's actually February 18th for Priceline. And I don't know if they have the correct one here, but this is early. This is 2/3, so February 3rd or early February. Skyworks is next week. Did I show this one already? Yeah. What's the other one? Oh, Avago. And Avago next week. So looks like next Monday. Anyway, so okay, let's keep going. V, that's another one. Shortable 200-day line becomes your short sale point here. I suppose it skidded just past it earlier and ran into this little bear flag, and now it's reversing. So you know, that's probably shortable here. You can use a 200-day line as your guide for a stop. So you see how I'm seeing a lot of these moving into areas that I would consider logical short sale points. It doesn't mean they have to work. Stocks can continue moving higher. That's going to depend on what this market does. So if the market starts to roll over, they're all going to roll over with it. And because I'm thinking that the market is exceptionally weak here, based on the fact that I'm seeing almost nothing that even looks palatable on the long side, except for the little trades I pulled off in names like Sedge, Solar Edge over the last couple of days. I mean, that's a nice little trade, but that's done. And First Solar is another one, and that's done. And Cyber was done this morning, and it's reversing now. So, you know, you get these little trades off the lows, and you take them and you run for cover, and then we see how the short side sets up. See, when we break, we're up 100 right now in the Dow. It's hanging there. Somebody says, I wish HGSI showed earnings time before or after the market. Well, you can go to briefing.com, and they'll show you exactly what time they're going to announce earnings. The other thing that you can do, and you know, use a little bit of common sense and resourcefulness in the fact that we have this thing called the internet. You guys heard of it? And you can search on the company's website, or you can just search on, you know, this the stock symbol earnings due date and see what you come up with. And you'd be surprised what sort of information you can get. That's why I'm surprised O'Neill can't get all of the dates correct. There's too many estimated dates when it's quite clear, even on the company website, when they're going to announce earnings. So don't ask me what's going on over there. I saw them come out, their institutional advisory business, which I used to be the head of, came out on last week and downgraded Mobileye to market perform. So what the hell does that mean? Market perform. I mean, anybody who's been paying attention to these webinars, I call this thing a short on late stage failed base, which is also a pod failure up here. And it's been a short all the way down. And now they're changing it to market perform. So what they're doing over there is they've now become a brokerage firm like everybody else, and they're going to imitate everybody else with their absolutely meaningless market calls on stocks, market perform, market out. What does that mean? I would say this thing is like severely underperformed the market since the middle of last year. So what are they talking about? And I think that's pretty sad. But with Bill O'Neill out of the picture, you have a lot of mediocre people, I think, in charge, and they have no vision. And they're going to sway with the wind, and they think by becoming like everybody else on the street that somehow that's going to be good for them. Maybe it is. I don't know. But in my view, it's not true to the cause. RCL, we talked about. That's, like I said, a short up here. CCL, I've got that one short. I'm up a few pennies on it right now, but it's not. Let's come on, baby. Come up. There we go. But it's not doing anything, but it's stalling. So I kind of like that. Maybe if the market rolls over, it'll come over. I'm not, looking for huge success today, but I am going to test the waters here where I see a trade where I can control risk very tightly. So I'm willing to take shots, and I have a little bit of cushion, not as much as I'd like. Of course, when the market breaks like it has so far in 2016, no matter how much you're up, you're always pissed because you're not up more, because you could have been if you had done things exactly right. But that's just the way it goes. And finally, last but not least, rather, I've got to get my bromides correct. Here's the outside reversal on LLTC. These analog chip makers like this one and MCHP, both were rallying, and these were shortable this morning if you're watching them on the 620. You notice how this comes into these lows here, and that's overhead resistance. LLTC, you could probably go through the whole group here, and it's probably the same thing. What are some other? Sanmina. Not so much. But, Intel also having a problem. Texas Instruments, you might want to keep an eye on. Same situation. It's an analog chip maker. And similar to LLTC and MCHP, I think there's a few others. For those of you who know about that stuff, you can check those names and check the group. But they come out with earnings next week, which could influence these names one way or another and create rallies that make them shortable. So while LLTC and MCHP, Microchip, and the Linear Technology were both shortable this morning and have reversed, they might offer another opportunity. But you're starting. But I think RCL, CCL. I like things that move in packs, and you're seeing a breakdown in these cruise lines. What's that other one? NLCH? No, NCHL. Norwegian Cruise Lines, NHCL, nope, somebody help me out here. Anyways, when things are moving in groups, that's when I like to hit them. That's why Expedia, I'm sorry, NCLH? Yeah, see how that's one, so the whole group is broken down, so there goes the Dow under 100 points, so now we're going to come apart. Let's see. Let's hope so, because I'm now about 90% short. No, 95% short now. Just as things hit my short sale points, and boom, 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 they just go off. So here we go. See if any of you are short any of these names as well, or maybe some of you think the market has double bottomed, and that's it. I know I saw Kramer on TV babbling about how some Fibonacci analysts had called the market perfect. There's always somebody who calls the market perfect. I remember Elaine Garzarelli called the 1987 crash, and so she became a big guru. And then that was the only call she ever made that was correct after that. She called a market crash in July of 1996. And a big sell signal, I remember, and that was an absolute bottom. We had a 13th-day follow-through. The market took off again in early July 1996. So you can check that on the internet. but her great calls, she was one and done basically. Anyways, let's go through some questions. Somebody says, if Exxon worked its way up and past 31.65, would you consider this a shakeout plus 3? Yeah, if I'm a dreamer, I guess. But the thing with shakeout plus 3s is this. First of all, it's not, if this is what you're talking about, I don't know where it has to go. If it got up to here, if it got up to 31.65, that would take you to the 50-day. This would be a short at that point. The other thing is, if a shakeout plus 3, it's fairly quick. It's not something, it's because it's a shakeout, okay? And then the thing turns back to the upside and starts shooting higher. It's not something that occurs several days after a low and then works its way higher. It has to have the feel of a shakeout, and that's the problem with a lot of these rules. And I'm going to say this, be upfront about this. I think it's the problem with the way a lot of you guys want to apply what you've learned. You think it's so simple and you just apply some simple rule and slap it on everything. I see people everywhere calling everything a 620 buy or 620 sell, and it all feeds into this idea, this axiom, that a little knowledge is a dangerous thing. And unless you've really become acquainted with how things work, you try to apply simple rules. I think simple rules for simple minds in the stock market, and that's basically what happens when you start trying to over-apply some simplistic rule and without really understanding the essence of what causes it. You can see it on the screen as the thing is trading. It has this feel of a big shakeout, and it's a big shake, not this sort of slow motion sort of move. So I've liked Intrexon on the way up. Maybe it has some potential to rally, but I would not rely on a shakeout plus 3 at this point. If it got to the 50-day as a reason to buy the stock, I'd want to see maybe some action along the 50-day and maybe a pocket pivot there, and maybe that would improve the situation. But it could just as well become a short right at that point. So just be careful about how you want to apply rules. It's like investing is not as easy as 1, 2, 3. I don't care what all those stupid ads and IBD tell you. It's a lot more difficult than that, and in these markets it's even more difficult. So be careful, be smart, use some common sense, and try not to over apply every single rule you want to apply. EA has gone through the 200-day moving average. Someone's asking about the 50-day could be where it finds resistance, because you're getting into this area of congestion here. So yeah, that could be a short. That's something to keep an eye on. So now we're up 122. See how this market, in 2 minutes, it could be turning the other way on you. So it's very difficult. It's not easy. And I would say even being short throughout the first 2-3 weeks of this year has not been all that easy, because what will happen is you'll see the market will break down, and then towards the end of the day you get this rally. And if you're short, you're thinking, okay, maybe I need to back off and put some profits in the bank. And then you do that, and the next day the market gaps down big. And so you're not as short as you want to be. That's why I keep saying, if I'm making money, I could have made a lot more if I had sat there short. But at the same time, you're exposing yourself to these sharp snapback, gap up type moves. And that's very dangerous to be sitting there heavy short. So I'm willing to work up a little cushion as we progress through the year, because I start fresh in January. January tends to be a rather quiet month, but I would say that this January is not. So that seems to perk my my little ears up in terms of things getting weaker and turning into a bear market. So anyways, let's go do some more questions. Gil, the Asian markets are up 900 points, NQ up 92, Dow up only 140 out of whack. What? I don't know what that means. Please explain, Sam. Any comments on Ulta price volume? Probably a short, if I remember seeing that pattern. Yeah, see, what you're starting to get now is, here's a late stage breakout. So it breaks out here, and now it fails. And see how the 20-day is above the 50-day, so that one comes into play on the underside of this base, because that's now failing. This breakout, this gap up is now failing, and so that becomes a short at that point. Okay? And you would use the 20-day line as your stop, maybe this high if you wanted to. But my guess is this thing's probably done. Salon, Ulta Salon Cosmetics and Fragrances. I don't know. My daughter, I think, is a fan of them. The other day, I actually, don't tell her this, but I went into her room looking for a small mirror because I was trying to look at a tooth of mine. and I just looked in this one drawer, and there was so much makeup in this. And like, that's like a 10 years supply of makeup it look like. So I'm not sure. I don't quite understand teenage daughters. If anybody has one and they figured it out, send me the handbook or the instructions. In any case, all I know is you don't want to criticize them, because whatever you criticize them on, you only encourage them. So if they bring home some loser, you know, that they're dating, you don't want to criticize them, because then they'll just like them more. What you want to do is you want to like the guy a lot. So they figure, wow, if my dad likes this guy, there must be something wrong with him. Anyways, that's the only thing I've figured out so far. Let's see. Somebody says, thanks for your honesty. Okay, you're welcome. Let's see. I think I'm at the end of what I have to say. There's a lot of ideas here I think I've just thrown out there for you guys. And it's fortuitous that we waited one day to do this, because I felt on Tuesday you probably were going to see a rally from there. So no reason to do a webinar yesterday. This morning, you're 2 days up. Maybe it starts to fail, or you start to get a better idea of where things are rallying to in terms of overhead resistance. And it gives you a better idea of where you might be able to short. So I think we're seeing that today. But, you got to be nimble. And I think if you're in cash, and you've been in cash since the beginning of the year, you're very comfortable if you're oriented that way. And if you're shorting, shorting is fun and you can make money. And I think the best performance I've seen so far from someone who texted me was up 22% so far to start the year. I think that's outstanding. And even if you're up 5, 10, 15, you're doing fine, slowly building a cushion and getting in position for making more money later on in the year. My tendency is to start out slow, build a cushion, and then once I have a cushion, try to push it. And last year when I would start to get up 25, 30%, I'd really try to ram it, and we really never went anywhere, so I'd keep giving up my gains. Not sure how I'm going to approach it this year, but I think that we have a better chance of having a bear market this year than we did last year. And I think de facto, let's look at some of these indices. You have the Russell. What is the Russell? The rut here? Yeah. It's in a rut, I'd have to say. And you can see, look, that's a bear market. And you have another new leg down, so that's busted. You look at the, this is going to have the wrong volume, but don't let that bother you. This is, that topped way back there, and it's been in a bear market. So the divergence there has been pretty clear. And it seems to argue for more downside from here over time. Whether that occurs today, tomorrow, or I'm sorry, it can't occur tomorrow because tomorrow's Saturday, but next week, whenever, we'll see. But I think you just pick off your opportunities as you see them in real time. So, so I'm just looking at what I see in real time today. I have no big predictions I'm trying to make. I'm just watching what's happening, but I think it was fairly concrete in terms of being able to figure out that Tuesday you were getting long in the tooth. You saw a lot of these big stock NASDAQ names from, Amazon to Netflix, Priceline, Tesla, Expedia, Palo Alto Networks, LinkedIn, and just go down the list. They were all undercutting prior lows, and we're in position to rally. And so you knew that's what was going on at that point. And that's when I got out of the way on the short side on Tuesday morning. And around midday, once I saw it turn, and I was watching that 48.21 low from October 2014, because once you break these lows, in the S&P, you're looking at the next possible low if it's not rallying, and of course that turned out to be the October 2014 low, and so it was somewhat textbook in that regard. But this book is anything but textbook. It's tough. And you have to be very nimble, and there's a lot of uncertainty. And I find myself jumping on something on the short side, and then maybe having to back away very quickly, and then coming back later, and backing away, and coming back later. But that's something I'm quite used to doing. So a lot of people, they have a problem with that, because buying and selling stocks is a ridiculous concept. You wouldn't do that with a piece of art, would you? Remember that old ad where the guy's at an auction, he buys a piece of art, and then he immediately says, I'd like to sell that. And they try to use that as an analogy for why it's absurd to sell a stock after you buy it, or say cover a stock right after you've shorted it. But they miss the whole point that the stock market is liquid. Art markets are not liquid, neither are real estate markets, and getting out of something quickly is not that easy. Although I know some people do like to flip real estate, but liquidity is fairly thick in the stock market. And so if you buy something and it's not acting the way you think it should right away, you can just bail out, clear your head, and rethink it. The liquidity in this case becomes your friend, not something that creates a contradiction in terms, because you wouldn't sell a piece of art right away, would you? Therefore, why would you sell I mean, that ad I thought was about as stupid as an ad can be. And it's okay to call things stupid. I know Bill O'Neill used to tell me, you know, you don't want to call this stupid. It's not diplomatic. But, you know, if Donald Trump can run around calling everything stupid, I think that's going to become the new fashion. So that ad is very stupid. And I just throw it in with all the other ads of like financial advisors who are going to help people retire, you know, with 3 vacation homes and all this other crap. They don't know what they're doing any more than anybody else is, that's for sure. So anyways, beware what the ads tell you. Anyways, we're up 122. The market's been fluttering about around that 100 level on the Dow, but it doesn't seem to want to break. So I don't know. Oops, what's going on here? But yeah, you're kind of stalling out here. We'll see how this plays out. But again, the setups are concrete. And so you want to play them on that basis. So hopefully I've given you guys some concrete ideas here to look at. And I've gone through a bunch of names which I think are a reasonable short sale list for those of you who are oriented that way. At least a short sale watch list to keep an eye on as and if the market rallies. So that's all I've got. And Dr. K, anything else, or are we done here?
I think we're in the middle of a lot of riptides, so, as always, just keep your stuff real tight, and, if you don't like this kind of environment, there's nothing wrong with being on the sidelines while the dust clears. Yes,
cash and golfing, surfing, anything else, hiking, whatever else you can think of. I know one guy, the guy who was up 22%, said he's going off dirt bike riding, which sounds cool. Just don't break your neck. Anyways, you guys, thanks for showing up as always. We'll catch you next week. Take care.
So long.